This is our Forex blog for January 9th, 2014, and these are our currency indexes, which I think are one of the easier ways of trading. They let you see a wealth of information right on the charts, and you can actually see the trend of each chart. Here's the dollar versus all pairs. We create a chart of it, just like the Dow Jones, NASDAQ. You can see the euros trending up, and when it breaks that trend line, it's very likely to go down, and when it breaks the hourly moving average on the euro dollar, it's likely to trend down. And basically, in a nutshell, you want to find currencies that are weak and sell them versus a strong, or if the euro is on the top of all the major pairs. So if the euro is going up, you want to buy it versus a weak one, and if it's going down, you want to find a strong one to sell the euro against. And it's that simple. So let's take a look at some of the other currencies. You can see the CAD's trending down all day, right? And so when the euro is trending up, especially until about 8 o'clock, you want to be looking for buys in the euro CAD. It's that simple. Strong euro, weak CAD, and basically the patterns that you're looking for are little pullbacks or sideways rectangle patterns. So a pullback would be something like this. Your stop underneath the low, maybe this pullback here. So you might have got into this trade and kind of had to wait a while for that trade to develop. You got in here, maybe got a loss there. But you can see that the force was to the upside. And a lot of traders don't want to have to learn how to trade, so you can use our Forex signals and just take the buys and sell trades by themselves. Here's an example of the euro dollar chart today, and you can see it did pretty good at finding trades that are likely to give you bigger profit than what your risk is. This first trade you would have been short right here and stopped out, very tiny loss. Another trade here, you can see the third one was a winner. This one was a decent sized winner. You had a very tiny loss right here. Huge winner, small win, and then you flipped and went short. Huge win, small loss, big win, small loss, small win. If you are in a trade and it has a sell signal, you get out of your trade and you go short. But you can see that the wins are many times bigger than what the average loss is. Super tiny loss, a little bit bigger loss. That one is recovered by this trade. This is a win here, so you're up on the day. You're still up on the day, but maybe just a little bit. Now you're up a lot. You're up even more. You gave back very little. You're up a huge amount now. You gave back just a tiny little sliver here and here, and you got it back on this one trade. Got rid of these two losses. And that's the key to trading. Small losses, big wins. It's not rocket science. And this is the euro dollar here. Let's take a look at some of the other ones. Here's the pound dollar. You have a small loss here, decent sized win. Now remember, you're in this trade here. Once there's a sell signal, you're out. So you had a very tiny win here. Big win. You're short right here at 86. You're out at 76. That's about a 10 pip win. You would have probably lost 3 pips on that trade, and then 8. You made money, and you always want to focus on the ones that are trending. If the euro is going up and the yen is going down, focus on the buys. So you can see here, small win, decent win, huge win here. You're in at 65 and you're out at 91. Small win, small win, small win. Now this one you're long here at 90 and you got stopped out at 85. You lost 5 pips plus the spread. And so that's the key to trading. Super tiny losses and much bigger wins. And like I said, you can also focus on these currency indexes, and especially when you see a currency that has a nice move up and pulls back, you can draw Fibonacci as well as trend lines on these charts. And if you buy a 50 to 62% pullback, that's a trade that's very likely to go up. So let's scroll these charts back and find one that's likely to go down when the yen right here is trending up. You can see The dollar's above its hourly moving average. The euro was pretty weak at this time. It fell dramatically. You could at that time, 10 o'clock, look for a euro yen sell. So here's the chart. And again, I like to kind of draw trend lines underneath the low. At 10 o'clock, it didn't break that trend line, so you waited. And about 25-30 minutes later, you got short with your stop right above the high. And you follow this down, maybe get out of the trade somewhere around here. And again, the key to trading is small losses, big wins. You have, let me change the color. You have this as your risk, and this is how much you made, and it's 2.5 to 3 times bigger profit in this instance than what your risk was. And even if you wait a little bit and took the next trade, which doesn't lead to as big of a profit, the profit on this is still about equal to what the risk was. Here is your risk, and here is your profit. It's about the same. Let's take a look at one more before we end today. You're looking for currencies that are extremely strong or extremely weak, and underneath the real-time trend we have a perfect oscillator, which is great for timing. It's more advanced. You can watch some of the other videos we have on that, and then we have the daily trend, weekly trend, and monthly trend. So here you can see the Swiss is going up. Usually at the outer bands the price reverses. As you can see, it reverses up. It's at the upper bands here. If you have an extremely weak currency like the Swiss, the weekly and monthly trend is just blood red, super, super weak. So especially when it goes up, pulls back, goes up a little bit, and kind of fails here, and then the double top over here, these are very high probability places to get short the Swiss. So you want to find a strong currency, or maybe one that's down too much at the lower band that has a very strong longer term trend. So let's take a look at some of the other currencies. The Swiss we're looking to sell at this time. Now you can see the pound just broke down. It's not quite near the lower band. The euro is trending up at this time, and the dollar has been trending up. Its daily and weekly is very strong, and it's at a major support area. So the dollar Swiss at 4 o'clock is one that's probably at least 50% likely to work, and it's worth taking the trade because if it works, you're going to probably make 15 to up to 50 pips on it, or risking 6 or 7. So let's take a look at this at 4 o'clock. And you can see that's exactly what happened. Here's 4 o'clock. We're looking for a reversal up because the dollar is at a very high probability support area, and the Swiss is very likely to reverse. And this is why I like using our statistical tools. You're risking literally this much. Now even if you got out of this trade when it's kind of chopping around here, you made a much bigger multiple than what you made 1.5 times at least what your risk was. And that's the key to trading. If you held on a little bit longer and kept moving your stop up underneath each swing low, you would have made 3 to 4 times more than what your risk was. Now let's find another one that might reverse at that time. The euro's going up. Unfortunately, it's at the upper band. It does have the daily and weekly trend is up. It looks like the monthly trend just shifted up. This is a little bit lower probability at 4 o'clock. The euro Swiss, we're looking for buys. And this one also worked. You're using the currency index to time it. Now at 4 o'clock, this one pulled back, and it's already kind of gone up a little bit, but it's pretty close to its lows. Your stop really should be underneath here. If you're very aggressive once you got in the trade and it started going up, you move it right up underneath this little level, little sideways flag pattern right here. And you can see it pretty much just kind of exploded up. The euro was extremely strong at that time. So again, risk versus reward, very big. 2.5, 3 times multiple of what your risk was. And that's really the key to trading. I think you will find when you have currencies that, and again, you can also draw fibs on longer term swings. Let's say the pound here. Daily, weekly, monthly trend is up. There's the last low. The perfect oscillator is at the -80 level, which usually is, causes reversals. If you look back in the past, right here and here, the market went down, right here, went down, -80, went up, +80 up here, went down, -80. This one's very likely to get a bounce up because it's pulled back 38% of that last swing. And you can see all the time frames of this is up. This Swiss is weak at 4. Pound Swiss very likely to go up at 4. And of course it does. Pretty much right at 4. And this is why you want to kind of wait for, and I'm going to just draw a little arrow when you should get in. At 4 o'clock we're looking for a buy. It's kind of going sideways. If it breaks out through the high here, you can get in. This one pull back a little bit. We would probably go long on this first green bar that went above the high, and your stop should be just right underneath the low. And you can see, risking 8 to 10 pips, it went up 20 pips. And if you bought the next pullback, it went up. Bought the next pullback, it went up. And typically we use tick charts or range charts to find more precise entries. So I will finish the class today by putting up a 5 pips per bar range chart. I'll go back to 4 o'clock. And with this, you can see much more precision in terms of entries and much lower risk. Here's 4 o'clock. You buy the first bar after a 3 or 4 bar pullback. This is your risk. And you can just kind of draw your trend line on the way up here, and you had this is your risk, very tiny. This is your reward. It's 3 times bigger win versus loss. And you can just, whether you're a scalper or not, use range charts of different magnitude. Little pullback, you went long, it went up, pullback, it went up, pullback, it went up, pullback, it went up. And that's the key to trading. Using the currency indexes to find the currencies most likely to trend. Or again, if you want to, you can just use our Forex signals because they're pretty accurate. This is about 15,000 lines of computer code I've been working on for about the last 9 months. And it uses Fibonacci pullbacks, Fibonacci profit targets, 28 different support and resistance areas, 3-line break. It looks for new highs and looks for certain bar patterns on reversals, and it also uses our statistical tools to make sure if it does buy, the market's not too weak to get in. And it also analyzes the swings. If the market makes a big move, 20-30 pips over the previous swing high, it's looking to buy. And that's basically how it works. Just like professional traders use swings in their analysis, so does our Forex signals.